Have you ever wondered why mutual funds could potentially be a better investment than single stocks? Welcome to the world of investments, a realm where money doesn't merely sit idle but grows, often exponentially. The allure of investments lies in the enticing prospect of wealth accumulation and financial security, a dream that motivates people to venture into the unpredictable yet rewarding world of investing. In this vast sphere, two investment avenues often spark curiosity: mutual funds and single stocks. Both offer unique opportunities and challenges, and understanding them is key to navigating the financial seas successfully. Mutual funds, a pool of funds from various investors managed by professionals, can offer diversification and convenience. On the other hand, single stocks, a share in a company's ownership, can provide potentially higher returns, albeit with higher risk. But which is the better choice? That's a question we'll explore in this video, so let's dive deeper into what exactly mutual funds and single stocks are. First, it's crucial to understand what single stocks are. Simply put, a single stock represents ownership in a company. When you purchase a stock, you are essentially buying a piece of that company, making you a shareholder. This entitles you to a proportion of the company's earnings and assets. But how does investing in single stocks work? Well, the concept is straightforward. You buy shares at a particular price with the hope that the price will increase over time. If the company performs well, the value of your stocks goes up and you can sell them at a profit. Conversely, if the company underperforms, the value of your stocks may drop, leading to potential losses. The allure of single stocks often lies in their potential for high returns. Imagine investing in a fledgling company that becomes the next tech giant. Your initial investment could multiply exponentially, leading to substantial profits. However, the flip side of this coin is risk. Single stocks are susceptible to market volatility and company-specific risks. A sudden market downturn or poor corporate decisions can drastically reduce stock value. Also, if you invest heavily in one company or industry, you put all your eggs in one basket, so to speak. If that company or industry falters, your investment can take a significant hit. Furthermore, investing in single stocks requires time, knowledge, and constant monitoring of market trends and company performance. It's not a passive investment strategy. You need to stay abreast of financial news, understand complex financial reports, and make informed decisions about when to buy or sell. So, while single stocks can be a lucrative investment, they are not for the faint-hearted. They require a deep understanding of the market, a high tolerance for risk, and an active involvement in managing your investments. Now that we have a grasp on single stocks, it's time to explore mutual funds. This alternative form of investment offers a different approach to growing your wealth, one that might be more suitable for those looking for diversification and a more hands-off approach, but more on that in the next scene. Mutual funds might sound complicated, but they're actually quite straightforward once you understand them. Let's start with the basics. A mutual fund is a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities. It's like a basket filled with a variety of different investments. The beauty of it is you're not putting all your eggs in one basket, so to speak. But how do they work, you might ask? Well, when you buy a share of a mutual fund, you're essentially pooling your money with other investors. This pool of funds is then managed by professional investment managers who make the buying and selling decisions. They use their expertise to build a diversified portfolio, spreading the investments across a wide range of securities. This diversification helps to mitigate risk, as the performance of the fund doesn't rely on the success of a single investment. Now let's talk about the potential benefits. Firstly, mutual funds offer diversification, as we've just discussed. This means you're less likely to lose all your investment if one company doesn't perform well. Secondly, they provide access to professional management. This is particularly beneficial if you're new to investing or don't have the time to manage your own portfolio. Lastly, they're flexible. You can typically buy or sell your mutual fund shares at any time without any specific market condition. But like any investment, mutual funds come with their own set of risks. The value of your investment can go up and down depending on the performance of the securities within the fund. Plus, while diversification can help reduce risk, it doesn't guarantee a profit or protect against loss. Despite these risks, the diversity and lower risk associated with mutual funds compared to single stocks make them a popular choice among investors. They offer a balanced approach to investing. combining the potential for growth with a level of risk management that can be appealing, especially to those just starting their investment journey. With a general idea of what mutual funds are, let's compare them to single stocks. So, mutual funds and single stocks, which one is a better investment? Let's dive right into it. When we talk about single stocks, we're referring to shares in a single company. That's like putting all your eggs in one basket. It's a high-risk, high-reward game. When that one company performs well, your investment soars, but when it doesn't, your investment sinks. It's a bit like riding a roller coaster, exciting sure, but not for the faint-hearted. On the flip side, we have mutual funds. Think of these as a mixed basket of investments. Within a mutual fund, your money is spread across a variety of stocks, bonds, or other assets. This diversification reduces your risk because even if one company doesn't perform well, others in your portfolio might. It's more of a gentle sailboat ride than a roller coaster. Now let's talk about potential returns. With single stocks, you could potentially make a lot of money if the company you invest in does well. But remember, the opposite is equally possible. With mutual funds, your returns may not be as high as a successful single stock, but they're typically more stable and predictable. Accessibility is another factor to consider. Single stocks can be bought and sold on the open market, making them easily accessible to everyday investors. However, they often require a fair bit of research and knowledge to choose wisely. Mutual funds, on the other hand, are managed by professional fund managers who do all that research for you. They also often have minimum investment requirements, which may make them less accessible to some investors. Finally, let's not forget about fees. Single stocks usually incur trading fees, while mutual funds have management fees. These fees can eat into your returns, so it's important to factor them into your decision. As we can see, while both have their merits, mutual funds often offer a safer and more diverse investment. So whether you're an adrenaline junkie or a smooth sailor, you now have the knowledge to make an informed decision. Happy investing. So, what does all of this mean for you, the investor? Let's take a moment to distill the key points we've covered in this discussion. We've journeyed through the world of investments, specifically focusing on the comparison between mutual funds and single stocks. We started by understanding the concept of single stocks. These are individual shares of a company's stock that you can buy, sell, or hold. Investing in single stocks can offer high returns if the company performs well. However, the risk is equally substantial. You're putting all your eggs in one basket, so to speak. If the company underperforms or faces a crisis, your investment can take a significant hit. Then, we delved into the realm of mutual funds. These are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. The beauty of mutual funds lies in their diversification. Instead of betting on the performance of a single company, you're spreading your risk across multiple assets. This can lead to more stable returns over time. But like anything in life, mutual funds are not without their drawbacks. They come with management fees and, depending on the fund, potential sales charges. Also, because a fund manager is making the investment decisions, you have less control over the specific investments in your portfolio. So who might prefer each type of investment? If you are someone who enjoys researching individual companies, analyzing their financial health, and betting on their future performance, single stocks might be more your speed. You have the potential for high returns if your predictions are correct, but remember, with great potential reward comes substantial risk. On the other hand, if you prefer a more hands-off approach, mutual funds could be a better fit. They offer diversification, professional management, and can be less volatile than individual stocks. They might be the way to go if you're seeking steady growth over time rather than the possibility of a quick windfall. In essence, both mutual funds and single stocks have their place in the investment landscape. They each have potential benefits and risks. Your preference might lean towards one or the other based on your financial goals, risk tolerance, and the level of involvement you desire in your investments. Remember, investing is not a one-size-fits-all game. It's about finding the right fit for your individual needs and aspirations. In conclusion, whether you choose to invest in mutual funds or single stocks, the most important thing is to stay informed. Understand what you're investing in, the potential risks, and the possible rewards. Remember, the right investment for you depends on your individual financial goals and risk tolerance. Always do your research before making any investment decisions.